I think we're entering a new era of considering risk differently. So historically, real estate risks have been more or less the same, right? You have a risk of a market, you have risk of population growth, you have a risk of not keeping your building leased or of rental income growth.
Climate risk is like another issue that investors in general are worried about. But it's interesting because, like, you look around the US and there are different, varying degrees of belief about what climate risk means for the future.
But now we have greater, perhaps uncontemplated risks coming into play. And some of those are natural risks. So the risks of things like hurricanes and wildfires, the risks of the destruction of infrastructure.
What we've seen in the data is looking at commercial real estate, like cap rates and growth in like housing prices. If we look at that geographically across the US, what we find is like areas that have a stronger belief in climate change tend to be more sensitive to disaster risk. So like, to the extent that there's a discount in real estate prices, both commercial and residential, to the extent that there's a discount reflecting that kind of disaster risk, it's going to be more exaggerated in areas that have a stronger belief in climate change.
There's always something. So I think it is really about finding those individual neighborhoods where you can mitigate or get comfortable with the likelihood of a black swan event or even just the ordinary course of life risk events happening.
We're taking it into consideration as far as the risk profile is concerned. Obviously, we see what happened with the insurance cost. We have not invested anything in California. People are leaving California. We are looking into states where there is inbound migration, not states where there is outbound migration.
And then I think as an industry, the burden's on us to help work to advocate for insurance and to bring the cost of insurance down, both for institutional owners as well as individual homeowners.
So there's political risk, which is the riskiness of the government financially. And because if that risk goes up, it's going to disseminate to the private sector. And like what that means is cost of capital, cost of equity, cost of credit will go up for companies.
It narrows the playing field quite significantly in terms of what types of investments would be palatable for an overseas long-term investor. Can you get comfortable with a 3 or a 5 year risk? Can you get comfortable with that for 40 years? And that is a tough sell. I think as an investor that's an overseas investor coming into this market, from my perspective, how do we quantify those risks? How do we qualify them? And then how do we adjust our financial performance around those risks?
Political risk comes and goes, but this administration is moving very quickly. So it'll be interesting to see how that plays out.